All right, we're looking at SSC Security Services Corp, symbol SECU on the TSX. They recently appeared in one of our larger reports, our Canadian small cap cash rich profitable company report. The symbol is SECU on the TSX. Like I said, trades around $2.75, about a $53 million market cap, 4.29% dividend. SSC is the largest publicly traded security company in Canada. It's debt-free, has approximately 3,000 employees from coast to coast. The company provides primarily physical security, 85 to 90% of the business, electronic security, about 5%, cybersecurity, 5 to 6%, services to corporate and public sector clients via two wholly owned subsidiaries. Now, SSC was previously known as Input Capital Corp, which was founded in 2011 as an agricultural commodity streaming company providing several flexible and competitive forms of financing, which helped Western Canadian farmers solve working capital mortgage financing and canola marketing challenges and improve the financial positions of their farms. On February 1st, 2021, Input acquired SRG Security Resource Group, Inc., as a platform for growth in the cyber and physical security businesses in Canada. On September 14th, 2021, Input announced that it would change its name from Input Capital Corp to SSC Security Services Corp and consolidated its common shares. Today, SSC's agricultural commodity streaming business is known as its legacy business and consists of agricultural real estate assets held for sale, including farmland mortgages. The legacy business's book is shrinking rapidly due to farmer buyouts via refinancing. The maximum term right now is in the range of less than 8 months. The company is collecting accounts and making slow but steady progress, turning assets to cash, working through the legal system. As SSC continues to wind down its remaining legacy assets, we expect that those cash flows will be allocated to from the legacy assets. They'll be reallocated to the security services portion of the business. Let's look at the recent financials. Good growth here in revenues, up 125%, EBITDA 180, EPS really just flat there. There's the increase in revenues was primarily due to the acquisition of Logix and the inclusion of Logix revenue starting on June 1st, 2022. Sequentially, revenue increased by about 5.2%, primarily as a result of seasonality. Adjusted EBITDA was about $1 million or 5 cents per share, up from 400,000 in that range, or 2 cents per share. Net profit for the period, the 9-month period, I believe it was just about 200,000 or around 1 cent per share. As opposed to in the same 9-month period last year, it was basically break even in that period. Now, growth plans ahead for this business, the security business, it's highly fragmented in Canada. According to Statistics Canada, there are over 2,700 companies providing some form of physical security services in country. Many of these are small owner-operated businesses with a tier. There's also a tier of mid-sized and larger, better capitalized companies. An opportunity to use here, there's an opportunity here to use SSC's balance sheet to grow into a solid, well-capitalized, profitable, and growing security platform. The strategy is to deploy the company's balance sheet into growth via acquisition and organic opportunities in the physical and cybersecurity industries. The plan over the next 3 to 5 years is to grow the business to the range of 200 to 300 million in annual revenues. Valuations right now, SSC currently trades with a 12-month EV to EBITDA of around 10, a price to sales of 0.52. These are relatively fair in our opinion right now, but they could progress lower as the revenues build and profitability could increase over the next year. So our take here, our conclusion, SSC is an intriguing, albeit low margin business that holds a strong balance sheet. About 20 to 23% of its market cap is in cash. As the company continues to convert its legacy assets into cash, the company's cash balance should help SSC make further potential accretive acquisitions. SSC is, again, a low margin business with an adjusted EBITDA margin in the last period, Q3, of 3.8%, which is, again, very low. Management has stated that the business should progress to the range of 5% in terms of EBITDA over the near term. It has the potential to move slightly higher than this over the long term and could give the business some decent profitability within this sector, relatively speaking, and it would help the company build cash as revenues are predicted to be significantly higher over the next 3 years. We are not opposed to investing in quality, low margin businesses if they check off all the boxes essentially that we're looking for. And SSC does check off a few boxes, including no debt, it's cash rich, low value, fair valuations, and it has above average growth from those acquisitions. Now, the margin profile, though, is what we kind of get hung up on here. It's well under 5%. Adjusted EBITDA for us, in our opinion, is too low to be investable in the near term. If we saw an improved margin profile, cash accumulation, and some better organic growth, we would consider SSC. At present, we just monitor the business and think the valuations are just fair right now. We would reassess if we saw higher margins over the long term.
And best part, it's from their headquarters is in Regina, Saskatchewan. Of course, I always have to bring that in. But no, what I would actually...
favorite place on earth, Regina.
No, actually, Saskatoon.
Favorite thing on earth is Regina.
But I guess you could say that. But no, yes. in all reality...
I just did.
Oh, geez. But no, in reality, like Ryan was saying, though, it's such a low margin business. So we ended up writing up a report on SSC as well as Avante Logix, who is now called Avante Corp. And we've been monitoring them for some time because they ended up selling their division Logix Security to SSC, which is what Ryan was talking about, in his little presentation there. So like just to show how low the margins were with the Logix Security business, which Avante sold to SSC. So this is Avante Corp's financial statements. In fiscal year 2021, when they still had Logix Security, their gross margin was about 23%. Well, jump to fiscal year 2022, when they no longer had that business, their gross margin jumped to, about 43%. So it's up substantially. But, maybe I should do my own piece on Avante, but the one thing that we're seeing with Avante as well is, we're seeing those gross margins increase, which is good, but we're still failing to see them get an operating margin. They're still losing money there. So we've talked to both businesses, and like Ryan said, they both screen well. But just there's still some things that we're hung up on before we would recommend them to clients.
Yeah, again, and we're not absolutely opposed to owning a low margin business. As long as it's making good cash, builds that cash over time, can return capital, which SSC is doing. But I'm not going to say the name of this company, but there's another company that we consider relatively low margin. It's in the 8 to 10% margin or profitability range, and this is not half that, it's almost a third that, so I mean, in that case, it is on the lower end, the lowest end really, that we'd be looking at. If you can bring it up above 5%, it's something we might consider. If they can continue to generate cash, use that cash to continue to invest back and grow the business via acquisition, so compound that cash over time, it may be a company that we'd look at. We'd just like to see it at least get up to the 5% plus range.
The really interesting thing about this company is how they're shifting from that legacy business, though, which was completely unrelated. It was what was it again? Was it corn futures?
Yeah, well,
or it's farm agriculture futures.
Yes, yeah, and it is a completely separate business. Mm-hmm. I believe we interviewed management. The management team, the CEO has background in the security industry, so it's good that that is his background. And to be honest, the interview, he's very competent, seemed like a reasonable guy, knew what he was doing in the sector, and fully aware of the margin profile and trying to bring that up over time. So it's certainly, like, when we screened through 3,500 companies, it made it down to the 40, the 50 that were in that report after 3,500 companies. So it screens well in a number of areas. But yeah, they certainly went from one area to a different area. But if they can consolidate it and use that cash to potentially grow within that industry, and eventually, a company like this potentially could be an acquisition target. Now, we'd never buy a company just because it's an acquisition target. But if you get to the 200, 300, even $400 million range in terms of revenue, there are some larger security firms that may want to pick you off at that point. So it is an interesting company, pays that dividend that we're looking at right now. Just bring those margins up. They're never going to have this is never going to be a high margin business. It just isn't in that sector. You can't have that, but you can certainly bring it up from where they were in Q3. And if they do that, then it's worth a second look once again. We're always monitoring these companies.